Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to GetRetiredStayRetired.com. And now, here's Craig Bolanos.
I know what you're thinking. You feel like you just had an exorcism, an out-of-body existential experience because the markets have been so incredibly volatile. Volatile, though, is not bad. It's an organic part of the investment process. In fact, I would argue volatility is the price. Volatility is the toll that people pay to good compound annual growth rates over time. Now, that being said, we've got a show packed of good information. It's all about sincere and actionable ideas to help you improve yourself and the lives of your loved ones financially. Because again, you can't just get retired. You got to make sure you stay retired. You don't want to survive retirement. You want to make sure you thrive in retirement. Connect with us online. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Phone number 833-964-PLAN. That's 833-964-PLAN. What's on our docket today? Later in the program, we got to talk about what you don't know about annuities that could hurt you. In addition, here's a different twist on estate planning. I want to give you some reasons on disinheriting someone and how to actually do it. And what's this stagflation thing? Stagflation, and why should people care? Well, I'm going to actually get started with that, and then we're going to talk about some investment solutions that you can use because I want to revisit something called cap and cushion. All of that, again, 833-964-PLAN, 833-964-PLAN, GetRetiredStayRetired.com. So what you've heard about for the last 3 weeks is stagflation. Stagflation. And people ask me, what's stagflation? Everyone knows what inflation is. I'm mad as heck at how expensive things got at one point in time. But what's stagflation? Well, I'm going to tell you what it is. I'm going to tell you why, if you're getting retired, you should care. Then more importantly, what we should do about it. So forget inflation. Stagflation's the buzzword. It's all over Wall Street. It's all over Facebook. It's all over any forms of media that you're trolling. And stagflation is nothing more than inflation that goes higher, meaning it costs you more than you want to buy the goods and services that you value and need, combined with stagnant economic growth, which also, by the way, means increasing unemployment. So, is stagflation a legitimate risk? It could be, but it might not need to be. Again, what I tell people right now is trust the process. Trust the process. And the process I'm referring to is everyone's a little bit unnerved over the headlines and what we've seen with trade, but we're not that far into it. And if we can get some positive momentum coming out of trade, taxation, etc., then we're going to be okay because we came into this environment with a relatively strong economy. The issue is going to be how much does the consumer slow based on the pace of negative news that they hear from the media. So when I think about, approaching a stagflation economy, there's several warning signs that I think Wall Street's pointing to. I mean, one of those is, of course, take the tariff for starters. If you announce a 10% baseline on goods coming into the country, then what that's going to do is automatically maybe raise prices marginally across the board. So that's one condition, is raising prices. And if we start raising prices, consumer confidence, which is already registering at a 12-year low. Yeah, right now, if you didn't know that, consumer confidence registering at a 12-year low. Small business confidence, small business is somewhat plummeting. then you might just see some behavior changes. And if there's behavior changes, that means companies aren't going to be selling as much goods and services to their end customer. And when companies aren't selling as much goods and services to the end customer, do you know what they do? Well, if you're not selling as much as you used to, you're going to slash your overhead. And one of the easiest overheads for a lot of companies to slash starts with cutting jobs. So next thing you know, you could start seeing the employment begin to rise month over month, year over year. And all of those conditions combined, what could be slightly elevated prices, a slowdown in consumer confidence, a slowdown in business owner sentiment, which then leads to reductions in force, reductions in the number of employees at the margins, has a compound effect where all of a sudden inflation goes up, the unemployment rate goes up, and oh my gosh, next thing you know, you could have a recession. Now, why is stagflation, though, so scary? I think a lot of people who lived through the stagflation of the 1970s, yep, this happened before, the 1970s, knows all too well what it can do. Seriously, knows all too well. And I think stagflation is really, if I were to nickname it something, stagflation's a double whammy for retirees. If you're just joining, we're talking about what stagflation is, what stagflation means, not because I think it's coming, but because it's trending in the media. So I want you to be informed of what people are talking about. Now, if stagflation is a double whammy for retirees, why would I say it's a double whammy? Because, well, number one, stagflation makes it difficult, especially if you're retired, to maintain your lifestyle without having to draw more money from retirement savings. Number two, it's a second whammy because in a period of stagflation, which is a period of escalating prices with slower economic growth, you're not going to get the earnings per share growth we're all accustomed to, we're used to, which would then mean stock prices don't advance as quickly as they have, and hence it's tougher for your portfolio to keep up. So now that we know what stagflation is, now that we know why I coined stagflation a double whammy, again, I don't think stagflation is going to occur, but what if it did? You know, one of the hallmarks of us at VestGen Wealth Partners is we always talk about preparedness and flexibility. Preparedness and flexibility, because if you take care of the downside, the upside's going to take care of itself. So how should you approach your portfolio construction during a potential period of stagflation? Well, I think the best thing to do is first, you gotta look at your risk budget. You have to control the risk in your investment portfolio. And that means spreading your money across multiple asset classes. Is the S&P 500 really adequately diversified? No. Is the Dow Jones adequately diversified? No. Just look at what United Healthcare did to the Dow Jones Industrial Average this week on, I think it was Thursday. Yeah, the last day the markets traded. Friday, we were all closed for Good Friday. So you really got to have a quality bias in your portfolio if you worry that you're going to be in a period of stagflation. And one of the ways to have a quality bias in your portfolio is to make sure that you're investing in cash cows. Investing in cash cows. And we've talked about them before. I want to talk about them again. What are cash cows? Cash cows are those companies that deliver a stream of growing cash flow. Because remember, free cash flow, that's the cash remaining after a company has paid its expenses, its interest, its taxes, its long-term investments. And when you have a company that has tremendous free cash flow, it allows that company to use that cash to buy back stock, which increases shareholder value. Use that cash to increase dividends, which increases shareholder value. Take advantage when you have free cash flow of market dislocations to do mergers, acquisitions, strategic growth of the company. And if you end up in a slower growth economic environment, you want to not just be diversified, you want to make sure you have cash cows in your portfolio. And one of the things we do is make sure we invest in those cash cows that are great companies of America because, again, high quality U.S. equities that trade at a discount, companies that experience those high free cash flows with the ability to grow dividends over time. That's just the hallmark of where you want some of your money positioned, just in case there's the risk of stagflation. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you go out there, take advantage and download our Trade War 2.0 publication for free. Download from our website today, Trade War 2.0. I want you to be able to better unpack these escalating tensions that have occurred thus far in 2025, give you a briefing, a clear lens on tariffs, the geopolitical shifts, the effects on the global economy, and take advantage. Subscribe to our newsletter while you're there so you can stay informed about our thought leadership and where we think things are going. Okay, when you're ready, and you've listened to us for years, heck, we've been on this station for more than a decade now. We have staying power. That staying power comes from strategies that are TNT. They're tested in the trenches. I too think we're durable. I too know that the collective sum of a multidisciplinary firm coming together, investments, financial planning, taxes, estate, retiree healthcare, long-term care, all bundled under one roof. That's really the VestGen difference, and I want you to experience it for yourself. 833-964-PLAN, getretiredstayretired.com.
In the Know Radio with Craig Balanas on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
Well, here's a crazy subject. I talk all the time, passionately, with vigor, that estate planning isn't about giving monies to the ones you love, that estate planning is about messaging, putting the ones you love in a position to be successful. But what about the other side of that coin? What about reasons to actually disinherit someone? Because sometimes there's a good reason to disinherit someone. And by the way, if you want to disinherit somebody, how do you actually do it? Well, I got news. We're going to talk about it right now. So listen, lots of people are navigating a second marriage. There's people dealing with estranged relatives. There's people leaving assets to charity. There are reasons to disinherit people. Some of them are very good and genuine. So, what if you no longer want to include someone in your estate plan? Well, how are you going to choose to divide your estate? I mean, listen, to each one of us, it's a very specific, a very personal decisions. But what I talk about all the time is if there is a reason, a valid reason, when you need to update and change the beneficiaries in your estate plan because you want to cut them out, you no longer want to leave them a bequest, well, you got to do it the right way. And if you're going to show your intention to disinherit someone, there's got to be some actual language in your written estate plan that this person is disinherited. Now, no reasons have to be given. You don't need to give the rationale. After all, it's your money. But the language you got to use, it's got to be clear. It's got to be easy enough to understand to prove that this is, in fact, your intention. So, if you're considering maybe how to disinherit, you could use what I call a disinheritance clause, or you could leave a bequest with a no contest clause to cut off any challenges, right? These are just some of the things you can do. Now, if we're talking about estate planning, there's probably a lot of people out there listening who don't even have an estate plan. And when you don't have an estate plan, that can cause accidental disinheritance. It can cause accidental consequences. Because remember, if you die without an estate plan, you die what's called intestate. It's called dying intestate. And when you die intestate, your states, it's whatever the state is that you live in, your state of residency, that state's intestacy laws determine how your assets are going to be distributed. And typically, they're looking within your family tree, right? And what do I mean by that? Typically, most intestate laws, succession laws, are going to give money first to spouse, children, grandchildren. then parents and siblings, then nieces and nephews, then grandparents, then aunts and uncles, then cousins, meaning it's looking to find people to give the money to. But if you don't want to have your estate plan controlled by the intestate laws of the state that you reside in, gosh darn it, you really need to do an estate plan. You absolutely have to do an estate plan. And if a part of that estate plan is making sure someone who is estranged from you, if a part of that estate plan is someone who has done you wrong, and there's no way that they're ever going to cure that wrong, and you're not going to forget, then make sure you are extremely intentional on how you disinherit them. And that means working with a professional to develop some disinheritance clauses, develop some no contest clauses, because you want to make sure you cut off any challenges. I think that's really, really key. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. Now, what about something else? You've got your new best friend in life, your new husband, your new wife. Maybe it's your new partner. Maybe it's a second marriage. It might be a whole lot of things. One of the biggest struggles that people have is, how do we protect the family home for the surviving spouse so that if you die, they don't have to move out? But how do you make sure that the proceeds of that property eventually make its way back into your bloodline? Everyone talks about it. Everybody wants it. But for some reason, people get caught up and don't get it done. You can do that through a qualified terminal interest in property trust, or I just refer to it as a life estate. So it doesn't make sense right now today, if you're on a second marriage and you have a home together, if you die, you don't want to necessarily leave the value of that home to your new spouse, which will eventually go to your new spouse's kids. Create a life estate so that they can use that asset, use that home you've created. But when they eventually follow you into death, becoming an angel overnight, then the proceeds of that property will go back into your children. Very easy, very simple to do. Something else I think about all the time is this. Maybe, just maybe, together you and your spouse are great financially, but maybe there's a financial imbalance. He or she needs the money, needs the resources that you have in order to pay the bills. Now, you want to honor your children while at the same time providing for your spouse. That same concept I just mentioned to the house can be applied here too. We can create a trust that benefits your spouse, where your spouse can live off of the income. That's the dividends, the interest, the distributions from the trust, but it'll make sure that the balance, the corpus of that trust, finds its way back into your bloodline. And why do I talk about these things? Because everybody knows they need to solve for them, but for some reason, no one actually chooses to take the time to address it. I tell everybody, let's get comfortable being uncomfortable, especially if it's a second marriage, it's a partnership later in life. You've already gotten naked together. Let's get naked financially and find a pathway to success. So what's the bottom line? If you don't have an estate plan, you got to get one. Estate planning is about messaging. It's not just about giving money to the ones we love. It's about putting the ones we love in a position to be successful. And yes, I tease this entire segment on how to disinherit people. But again, there's reasons you do it. Divorce is real. Having troubled offsprings with dependency issues are real. Being estranged from family members, they're real. Dealing with the need that maybe an adult child or a grandchild has special needs and is qualifying for government benefits, and you don't want your wealth to disqualify that person from receiving the government benefits, that would be a way of disinheriting them by putting the money into a trust for their benefit, not giving it to them directly. I mean, there's so many things you can do, and I want to help. 833-964-PLAN. That's 833-964-PLAN. 964 plan. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. And let us help you craft a narrative that's representative of your current state and honors your past state and protects your future state of what you've built together. Now, people say, what are the documents that I have to have? Everybody gets a will. I think you know this by now. Everybody gets a will. But some people are going to need to graduate from a will into a trust. Other people are going to want to graduate from a will to a trust. What are the reasons people do trust work? We all know it by now. You want to bypass probate. Maybe you're financially successful and you want to be elusive of any death, transfer, or inheritance, what people call estate taxes. For others, you might need to create some trust work to have special parameters along the lines of what I just mentioned, because you want to disinherit somebody, or you want to give someone use of an asset or use of a portfolio, but then make sure when they die, the money reverts back to your bloodline. But don't just focus on the drafting of wills. Don't just focus on the drafting of trusts. You also need to be bespoke, perfectly curated with the easy stuff. That's your powers of attorney for property. Should they be durable powers of attorney for property where you name an agent and give them abilities today? Or should they be springing powers of attorney for property that only go into effect after a trigger occurs? Should you have powers of attorney for healthcare? Of course you should. You should. You should make a determination now, not just as to the quantity of life, but the quality of life. You should build in HIPAA. Those are privacy waivers. So everybody in your family can know of and be informed and communicate with doctors, but not have decision-making authority. You should make sure that you also have living wills. You shouldn't just tell the ones that you love what your intentions are. You should make sure it's clear to your healthcare providers, what I call your attending physician. And above all, you just need to find a pathway to make yourself vulnerable, to talk about money, what's important about money to you, your spouse, your kids. It's that messaging. It's easy to leave money to people. It's a little bit more tough to leave money with messaging and values and intentions. And I think if you're going to write your last manuscript, you're going to write that last document, make it that narrative, then let's make it a reflection of your voice. Boilerplate documents, yeah, no one needs them. Something customized, that's where we exist. 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. Download our Trade War 2.0 guide. Take a look at all the media so you can understand our thought leadership relative to markets and other things. And let us help you plan for your future while honoring your past with a custom estate plan today.
More in the Know Radio. You want more in the Know Radio? You can't handle more in the Know Radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
So I think it's time we start putting some tools in people's portfolios. Again, different arrows in the quiver that they can use to put them in a position to be calm when it feels a little bit chaotic. And that brings us back to a concept we've talked about time and time again, is to what degree, if any, do people want to engage in what I call cap and cushion. Some people call them buffered ETFs. We call them cap and cushion. And really, it's about defined outcomes. You know, it's having a specific outcome that I think is really interesting, right? And having a specific outcome means this. I want to participate in a stock index up to a cap. And in exchange for having that cap, I want to have some downside protection. That's essentially what it is. And defined outcome investing, this concept of cap and cushion, I think it gives people the ability to have, in some circumstances, some better practice management. And practice management can translate into better managing your emotions by keeping yourself engaged in capital markets, meaning no destructive behavior. I think number two, defined outcome investing or cap and cushion can help with portfolio construction. How does it do that? By seeking to reduce volatility, balancing that concept of income or growth. I think that's key. Third, how to do it. There's so many different ways to do cap and cushion, but I think the best answer is something that's not over engineered. There's a reason, taxation wise and other reasons, to simply use the benefit of an ETF wrapper. I think it really puts people in a good position moving forward. So when I think about this concept again, about defined outcome investing, what is it? Why does it work? If you find yourself today in this environment saying, if I could invest and get 9 to 10% upside in the stock market today, but protect the first 20 to 30% of downside, I think that's interesting and intriguing to a lot of people, because people worry about bear markets, people worry about recessions. But given the market's already come down from its peak, any bear market would likely be contained in that 20 to 30% downside protection. And as long as someone had a cap where they could make not 2, 3, 4, 5%, but someone could make like a strong 9% rate of return, that's probably a good idea. And when you're thinking about cap and cushion, you're thinking about different ways to use this. I think what really matters to people is doing it in such a way that it's easily digestible. And cap and cushion strategies come in multiple forms: 1 year, 2 year, 3 year, 4 year, 5 year commitments. Let's keep it simple. Let's make a 12-month decision. It's too hard to look that far into the future. It really is. But if you want to participate in what I call a cap and cushion strategy, you want to have some defined outcomes, I think it's a great place to keep you engaged, to manage your emotions, and allow you to continue to participate in what I call a slice of America, which is ultimately what investing in stocks is really all about. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com, getretiredstayretired.com. Now, let's give some additional ideas of where somebody could actually deploy this today in a 1-year strategy, so you have an idea of what's available to you. Say somebody wanted to participate in the S&P 500, but today you didn't want to have any downside, meaning you're going to buy a cap and cushion strategy today. The way you're going to earn money or earn interest is you're going to be tied to the S&P 500, but you want a 100% downside buffer. Well, if you do that, you can achieve a cap today of about 7.5%, meaning your upside is capped at 7.5%, but your downside is 100% protected. So that kind of gives you an idea in an extreme way of how you could use this. So maybe you're sitting here and you're biting your fingernails and you're worried about what's next. You're worried about where the economy is going. You're worried about where the market is going. You're thinking of selling a portion of your stocks and just putting it into cash. Well, maybe a better move would be to take a little bit of money out of stocks, place it into a cap and cushion ETF, or in this example, let's use an ETF that has 7.5% upside with 100% downside protection. That way you can go back to sleeping at night knowing as long as you hold the cap and cushion ETF till its term, 12 months from now, you can't lose money and your upside is capped. Most people might think logically, you know what? That's probably a better move than selling out and putting it in cash. Okay, 833-964-PLAN, 833-964-PLAN. go out to our website, getretiredstayretired.com, getretiredstayretired.com. Someone's going to ask me, why would a cap and cushion strategy be more advantageous than a fixed indexed annuity? It's not. It's just a different tool. A cap and cushion strategy in an ETF wrapper protects your liquidity. It protects your choice. You don't have to sign up for a 5 to 7 year commitment, but arguably, the amount of cap, 7.5%, is less than that which you can get in other products. So that enters in the fixed index annuity world. In the fixed index annuity world today, you can earn interest by participating in a broad stock index like the S&P 500 up to a cap. There are cap rates that exist today in the 9.5% to 10% range. And there too, you won't experience any downside because, again, a fixed index annuity allows you to participate in the growth of a stock index without ever experiencing any day of the loss. But those fixed index annuities aren't going to be liquid. They're going to cause you to make an investment for a 5 to 7 year period. So there's different flavors of different strategies for anybody in today's market. I think what's important is simply getting educated, which means you're informed, which means you're empowered to know what choices are available to you. And when you're educated, informed, and empowered with choice, you can start moving from where you're currently at to a position that meets your emotions, which is your risk tolerance, while staying in line with what really matters is your risk budget, because it's your risk budget that should always be your guiding principle if you want to get retired and stay retired. So that means you got to have a plan. You got to have a plan. And if you don't have a retirement plan today, it's time to reassess and benchmark that you're on track. I want to help you do that. Go out to our website, getretiredstayretired.com. Sign up for a complimentary consultation. Work with one of our dedicated team members to create that retirement plan so you can see your glide path. Once that retirement benchmarking is done, let's spend some time talking about what you can do to improve the efficacy to get there. And at the same time, let's talk a little bit about the emotional dynamics of money, especially when the news headlines and the markets are moving so fast. And that might lead to a discussion of how someone can use liquid ETFs, to accomplish cap and cushion strategies, aka 7.5% upside with no downside over 12 months. That could lead into a strategy and a discussion of how someone might want to use a fixed indexed annuity to accomplish 9.5% to 10% upside with no downside, but it comes at a cost. The cost is you have to tie your money up for 5 to 7 years. But there's so many choices out there. I just want you to have the information that you need. 833-964-PLAN. 833-964-PLAN. Go out to our website, getretiredstayretired.com.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
You know, somebody asked me the other day, how do you endure? How do you continue not just to survive, but thrive through environments like this? And it reminds me of this. You can't be reactive. You need to be proactive. And proactive meant that someone came into the event since the Rose Garden speech where we dropped a nuclear bomb on the concept of trade. We've since moved the lines of what the policy is going to be on at least 2 occasions. But if you came in with a strategy like a cash flow reserve account that essentially led you to see that you would have a minimum of 3 to 5 years. That's a minimum of 3 to 5 years of dedicated, high quality, safe money markets, treasuries, and bonds. Then you can endure the chaos that's being created in financial markets through trade. But if you didn't come into this with that very simple strategy, then you don't have a strategy. You don't. You're being reactive. I think number 2 Part of being proactive is being prepared and flexible. We talk that 2025, our investment theme was pragmatic optimism. And the way we were going to implement that theme in 2025 was under what we call diversifying your diversifiers. Now, don't get me wrong, our plan was to do the addition of diversifying the diversifiers in the second half of the year because we assumed that you would see deregulation, security at the border, renewal of the Tax Cut and Jobs Act, government efficiency, and then you would use trade. Well, we just did the exact opposite order of operations. We started with trade. What's my point of all that? My point of all that is this. If you have an advisor and you're worried that nothing has changed, or you have an advisor who says this is going to clear up quickly, I don't think it clears up quickly. Now, that doesn't mean it's a foregone conclusion that we're in a recession, but this isn't all going to be handled in a couple of weeks. We have to recognize that the complexity of negotiating trade on a global scale is resetting a global scale. And when you got people like China, even if they carry a stick that's smaller than ours, it's still a big stick. And guess what? They're dug in. They're tough. They don't think in terms of days, weeks, and months. They think in terms of decades. They play the long game. And that in no way, shape, or form means President Trump is not up to the task. He is. But it's indicative that this could go longer than people think. And that's why I think you need to look at all the tools that are at your disposal. Today, we talked a little bit about cap and cushion, those defined outcome ETFs. Today, I alluded to the fact that FIAs, fixed index annuities, are an option. Previously, I have talked and hammered home for those who want to take some equity off the table but don't want to put it into traditional fixed income. Look at credit and very carefully look at the world of private credit. If you qualify, I think investing in private credit still has merit, even in an economy that's slowing down. In addition to those things, we've talked time and time again that if you're going to invest in America, a part of that should be great companies of America. A part of that means you're investing in cash cows, companies that are generating sufficient cash flow, the type of cash flow that allows them to navigate this because they've got the money to pay the dividends. They've got the money to run their operations. They've got the money to buy stock back when the price goes low. They've got the money to buy out competitors to better integrate their supply chain and their ecosystem, because this is going to be a market that broadens. It's a market that screams, don't just cap weight your indices, equal weight your indices. We've talked time and time again that it's last call. Did you hear it? It's last call for fixed income, everybody, because what fixed income, meaning bonds, because what's going to happen is interest rates are going to come down. I know people are worried about stagflation, inflation going up with economic growth slowing. Yes, that is a risk, but I still don't think we're there. This is not a repeat yet. Not a repeat yet of the 1970s. But if you want to be thinking about what to do, if you believe that interest rates are going to come down, I do. I go out to the CBOE Fed tracker and I see rates of 3.25% to 3.5% by the end of the year. That means we're talking about 75 to 100 basis points, 0.75% to 1% worth of cuts. Well, that means you're 5% money market of yesterday, which is now a 4% money market today, is going to be a 3% money market by the end of the year. Well, maybe you ought to lock in some longer duration assets to enjoy these coupons. I mean, you can build high quality portfolios today of bonds that are running at 5.16 to 5.26%. If you're clipping 5.1 to 5.26% worth of interest, that's your APR, that's your yield to maturity. Oh my gosh, if you're only spending 3-4% from your portfolio, but you're earning 5%, are you going to run out of money? No, of course you're not. So there are so many things that you can do. Speaking of diversifying your diversifiers, I'm going to mention something else. I think there's a reason for people to focus on undeniable trends, undeniable secular trends, such as industrial warehousing. I think it makes sense. Don't get me wrong. Everyone's worried about a slowdown in the economy. Everyone's worried about a slowdown in goods and services. I agree with that. The consumer psychology is at a 12-year low. That's consumer sentiment right now. But to think that you're not going to continue to see retail move online, to continue to think that you're not going to see retail continue to be omnichannel, meaning companies are going to have a strong online presence combined with a brick and mortar footprint, but in a smaller retail shopping network, fully supported and backed by warehousing that can get you the goods and services that aren't in stock in the store within 2 to 4 business days. That's where the world is going. And industrial warehousing as an investment theme supports that. So I think the bottom line here is this. If you don't have a plan, get one. If you don't have advisors that aren't communicative, we had our forecast meeting. We're on radio. We're on TV. We just had our firm-wide conference call. We did that last Friday. We have another conference call coming up the first week of May for everybody, because it's important when things are tough out there, you don't run away and hide. You run to the fight. You don't retreat from the fight. That's how winning is done. Winning is one step, one punch, one round at a time, one step, one punch, one round at a time. It's doing things with wide scale. It's never making all or nothing decisions. It's having processes that are tested in the trenches. I know exactly what we do for our clients when the S&P 500 trades up from here to 5,600. I know exactly what we're doing, why we're doing it, if the S&P 500 trades down to the 4,400 level. Why? Because you got to have a plan. You can't get to 5,600 on the S&P and say, what do I do now? You can't get to 4,400 on the S&P and say, gee, team, what do you think we should do? It needs to be pre-planned out, because when it's pre-planned out, it's executable. This is an execution business. Your retirement is an execution business. It's a mathematical equation. That's what we offer. And you know what? It's funny. My producer's watching me right now in the booth, and he's like, wow, you're pretty impassionate about this compared to the other A, B, and C block that we just did this morning in the hour. Well, you know what? I am, because this is what we do. This is why we exist. You want to get retired and stay retired. You need information. You need sincere and actionable ideas, and you deserve with advisors that aren't out here selling products. You deserve advisors who have a very genuine vested interest in your success, who are never ever going to compromise by putting the firm's revenue ahead of what's in your interest. That is the hallmark of a fiduciary. That is a hallmark of what we do at VestGen Wealth Partners. And I am darn proud to lead a team of professionals that get the work done every single day. If that resonates with you, I want to hear from you. I want to talk to you. Our number, 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. That's getretiredstayretired.com. More to come. Craig Bolanos, VestGen Wealth Partners, in the know, AM 560, The Answer.
Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560, The Answer.
I can't believe it's almost an hour. I mean, we talked about how to actually disinherit someone if you want to, in the same way how to support people with your estate plan. We made progress talking about cap and cushion and how it can allow you to stay in the game, stay invested, but protect your downside, or stay invested and manage your downside. We embraced fixed indexed annuities and the concept of how that could support a different version or complement the liquidity of cap and cushion with enhanced participation in cap rates. We just got done acknowledging all the ways that people can diversify their diversifiers in a year of pragmatic optimism. In addition to those things, we talked about cash cow investing, because people should have a quality bias. And of course, we talked about stagflation or no stagflation. What is it? Why is it a double threat to retirees? And what can you do about it? If you missed any of this, check out our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. If you listen to this show, if you're like me and you're on Salem all day, we've got some things in common. Pick up the phone, give us a call. Let's literally talk about what's happening in the world, how it affects your money, and what steps you can do to make sure you too don't just survive retirement, but thrive in retirement. Okay. I'm Craig Bolanos, co-founder, VestGen Wealth Partners. We've assembled this diverse group of professionals, all coming together under one roof to create a family office experience for everybody. That's investment advisory services. That's financial modeling. That's estate and legal. That's taxes, tax planning. That's retiree healthcare. That's long-term care. That's everything that's end-to-end wealth management. VestGen, Vest is to be vested in our clients' success. Gen, generational wealth planning. Because we know that if your kids are good, you're good. We know that if you're still survived by mom and dad, if they're good, you're good. Money and financial security is a generational topic, a generational discussion, regardless of where your wealth is on the spectrum. And I want someone that helps you align your wealth with life so you can live more, worry less, and pursue everything that matters to you. Give me a call, 833-964-PLAN. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com.